Right, welcome to our today's session. This is financial management. It is paper number 8 as far as CIFA syllabus is concerned. Paper number 8. Financial management, as the name suggests, we shall be looking at how do we get finances, how do we invest them, and how do we get the return. Then after getting return, how do we share among the shareholders? So that is basically what it means when we talk about financial management. The subject has 14 topics. The subject is a bit wide, and that's why we are expected to be very much committed as far as classes are concerned, and assignment are also concerned. 14 topics is not a joke for a period of 3.5 months before we sit for our paper. So under these under this topic, we shall be able to explain the nature and scope of financial management. But to describe the nature and functions of financial institutions and markets. Nature of financial institution and market. Analyze the sources of finance for organization and evaluate various financial options. Then number 4, we shall be able to evaluate various investment decisions scenario available to an organization. Some of the investment decision that each organization may opt to use. Then we have evaluate the performance of the firms using relevant financial tools. Make appropriate capital structure decision for a firm. Value financial assets under the firm. Make appropriate liquidity and dividend decision for a firm. We shall be able to see how the dividend is distributed. Evaluate current development in the field of finance and their impact on financial decisions, such as emerging issue or emerging trend. We usually call them contemporary issues. So, when we talk about this subject, which is financial management, we have said that we got 14 topics. 14 topics. One of the topic class, it is the overview of financial management topics. So we have 14 topics. The first one, it is the overview of financial management. Overview of financial management. Under which we shall be able to look at several items. Like theoretical framework of financial management. We shall look at that. The goal of a firm and the corporate strategy. The agency theory. That is where we are going to look at the agency theory. You know, when you talk about agency theory, it is the principal-agent relationship, whereby the principal delegates some duties to the agent in order for the agents to do what? To take care of the principal's either asset or such. Then we have measuring on managerial performance and ethical issues in financial management. That's all that we're going to cover under the overview of financial management. Topic number 2, the financing decision. The financing decision. I know you guys, you have several investments, you have several projects, and those projects, there's no way you can just undertake those projects without getting finances, either from outside or from inside. So financing decision. Why did you choose that form of financing? Why did you choose maybe to get finances from a SACCO and not a bank? So we shall be looking at the financing decision. The nature and objective of financing decision, factors to consider when making financing decision, sources of finances for enterprises. We shall be able to evaluate all those sources of finances. Then we shall be looking at evaluating of financing option, then method of issuing ordinary shares, method of issuing ordinary share. Topic number 3 class will be financial institutions and markets. Financial institutions and market. That will be our topic number 3. Financial institutions and market. This is where we find things to do with the regulatory authority, the capital market authority, the Central Bank of Kenya, and their functions. We shall be able to see all of them. We shall look at the overview of our financial system, the nature and role of financial markets, Nairobi Security Exchange, that is NSE, and its function as well, stock market indices, central depository system, and automatic trading system. We shall look at their functions as well. The next thing under the same, we shall look at the timing of investment at the Security Exchange, regulations of financial market. Who do regulate the financial markets? Of course, central bank, it is in the front trying to regulate the financial market. And that's why you find that if we want money circulation, if the central bank wants money circulation in a country, what do? Do they raise the interest rate or reduce the interest rate? Somebody. We want to increase money circulation. What do you think happen? By the financial management, it's a matter of application. It's a matter of relating to the real world. You see, it's a branch of economics. So if the government wants money circulation, what do you think happens? The regulatory authority make sure that at least the interest rate is low. Now, if the interest rate is low, there'll be more circulation of the money. Why? Because people tend to borrow. When the interest is low, you borrow, right? You borrow more, and that make the money to circulate. Then we shall look at the risk-facing financial institution and the factors responsible for the rapid development of financial institution and markets. In fact, a financial institution and markets have rapidly developed. They have developed very fast. Very fast. Now, page number 4 will be a very interesting one, which is time value of money. Time value of money. In most cases, I say that this is the backbone of financial management. Time value of money is the backbone or the skeleton of the time value of money. And this is important. This is important for every student to get to understand this topic, because you find that it cut across in those computation topic. You find that this topic is involved. It cut across. So we shall look at the concept of time value of money. See what is the time value of money, the meaning of time value of money, a concept of time preference for money, and then we shall look at the relevance of the concept of the time value of money, the real versus nominal cash flow. We shall look at loan amortization schedule and sinking fund, discounting technique, and compounding technique. All those will be found under topic number 4, which is time value of money. Time value of money. Time value. Simply, this means that the value of a shilling today is worth more than the value of the same shilling tomorrow. So if you're to do something with the money, do it today. It has more value. Business stroke financial asset valuation is our topic number 5. Business stroke financial asset valuation. This is our topic number 5. Topic number 5, we shall be able to value several items like valuation of owner share, valuation of debenture, valuation of preference share, and so on and so on. We shall be able to value part. We shall be able to even get to know how the right issues are valued. The right issues are valued. The right issue are valued. At the end of the day, part will be done. Then we have introduction to capital structure decisions as our topic number 6. Introduction to capital structure decision. Capital structure decision. Introduction to capital structure decision. Introduction to capital structure decision. That will be our topic number 6, and it is a very interesting topic. It is a very interesting topic. You see, when we talk of capital structure, every organization, every company, it has its own capital structure, and the capital structure class is made of several items or components like ordinary share, the debenture, preference share. So all those components do make a complete capital structure in a certain organization or the company. So we shall be able now to value and see how maybe to get things to do with the working capital or the weighted average cost of capital. We call them the WACC. Under this, we shall look at weighted average cost of capital, weighted marginal cost of capital. Very important, highly examinable, and we shall be able to see how it is done. Then we have topic number 7, which is the introduction to capital budgeting decision. Introduction to capital budgeting decision, number 7. Introduction to capital budgeting decisions. It's also an interesting topic. It's also an interesting topic because we shall be able to use the appraisal technique in order to make several decisions in an organization. We will be using like a technique of NPV, net present value, to value or to evaluate whether a project is viable or not. Most cases, we shall be using that word, viable. Viable means profitable. So to evaluate whether the project is profitable or not, we shall use several techniques. We have modern technique and traditional techniques, and we shall be able to differentiate the two and see how they are used to help us evaluate a project. Then we shall be having topic number 8, which is financial statement and analysis and forecast. Financial statements and forecast. Now, this topic is an advantage to all students because it is filed in financial reporting and also under financial management. The financial reporting and financial management. The only difference is that under financial management, we shall look at the aspect of forecasting, predicting the future performance of the company. Under financial reporting, that one is not found. So we shall be able to look at all. So if we are looking for the tools and these, they are the same as those found under financial reporting. From that point, we shall go to topic number 9. Topic number 9, which is a very interesting and a wide one, which is working capital management. Working capital management will be our topic number 9. working capital management. Working capital management class. At any given point, please note, when we talk of working capital, we are talking over several items that help the organization to do what? To earn revenue. Right? For example, if I talk of stock or inventory, when I talk of inventory, that is a component of working capital. Cash, component of working capital. Receivable and also payable. You see, the four form the component of working capital. Now, how do I manage inventory to make sure that when customer come to our offices, do not miss to get the product? How do I manage the inventory? How do I manage the debtors, the account receivable? To make sure at the end of the day, the business is not at risk of writing off all those debt. How do I make sure that those people who owe me as a company, they pay on time? So the organization or the company come up with several policies that help them to manage what? To manage the inventory, to manage the receivable. So you come up with your own policies and you'll be able to manage any of the component, even the cash, the receivable, payable, and such. Then dividend decision, topic number 10. Dividend decisions. That is a topic by its own. Dividend decision. Yes, you're in a circle. Every year you receive some dividend from that circle. Now, we say that dividend are derived from retained earning. What does that tell you? If the company or if a circle does not make profit, if they are not retained earnings, they are not dividend. So if the performance of the company or the circle is not promising, please don't expect to earn dividend. So through that, we shall use two methods to see how dividend is shared. Then number 11, we have introduction to portfolio analysis. Introduction to portfolio analysis. Portfolio. Portfolio are different types of investment. Portfolio will always refer to different types of investment. It can be investment depending on what you're talking about. Portfolio, it is a group of investment under this, right? So there are two things that are associated with this. As an investor, you need to invest and then get something. You invest and then get something. What do we expect to get after investment class? What do we expect to get after investment class? What do we expect? What do we expect? Somebody? We invest, then we expect something. What do we expect? Return. Thank you so much, Annette. Yes, we do invest expecting that we are going to get return. Something on top. I invest 10 million. I expect to get not 10 million, but amount more than 10 million. In fact, when I invest and get amount less than 10 million, that investment is not worth for me. to continue with it. And it happens. It happens. It happens. So you find that we have the returns, hizi haziachani, and risk. So your expectation, if you invest 1 million today, you expect after some time, you get maybe 1.5 million. Yeah. Now the return is 0.5 M. That is the return. Sawa. In business, we cannot be static here and say that we will always get returns. No. Sometimes you get loss. Whatever that you expected, you get it, you're not able to achieve that. So 1 million and we get 0.9. So the result also 0.1 due to what? Due to the risk. That loss is gotten due to risk. So simply through this, you are able to define what is return. You are able to define what is risk. Able to define what is return. You are able to define what is risk. So if I say that risk is the deviation from the expected return. Deviation, now this is the risk. Deviation from the expected return. The amount more than what we had invested is the return. Okay. So it is a very interesting topic that we are going to look at it together. It's a very interesting topic. Number 11. Then we shall look at topic number 12. Shall look at topic number 12. 12, which is Islamic finance. Islamic finance. We'll be able to see several terms that Islamic people do use according to the Islamic law. Then 13, we have the personal financial management. Personal financial management. And the last one is emerging trends or contemporary issues. Emerging trends or contemporary issues. So class, I think those are the topics that we have as far as financial management is concerned. You can see it's quite a wider area. Financial management is a bit wide, but with the cooperation, with the commitment that you're going to make, and Mwalimu is going to make, we are going to complete this on time before we do our exam. Maybe 2 weeks to exam, 1 week to exam. We shall be done with this, and all will be okay. So class, up to that point, please confirm whether we are together. Are we together up to that point? Are we together? Are we together? Are we together? Okay, good. Now, I just want us to do something today. And I always start here. Okay. For these topics, if I try to analyze the topics here, class, topic 1, 2, 3, these are theory topics. Topic 1, 2, 3, they are theory. Yeah. From topic 4, 5, 6, 7, 8, 9, and 10, 11. They are computation topics. Now, from time value of money, These are computation. Aha. The last three here, they are also theory topics. Theory topics. Previously, what we have been doing, we have been starting with the computation topics, after which we embark on the theory topics. For so long, we have seen that working. Start with the computation. So we start from time value of money all through up to where we have the introduction to portfolio analysis. And then we start, we embark on the theory. Should we continue with that system? Should we continue with that system? Let me hear from you. That's with the computation. And then we embark on theory. Is that technique okay with you? Mm-hmm. Yeah, it's proven for many years. We've done that. Because we have realized that computation topics are many. And if we try, we start here at the topic number 1, tunamaliza. You'll find ourselves the second month bado tuko. And you need all these concepts. For the theory class, what we do, I usually share some handout, some notes. You make some short notes. So as we continue with the computation topics, you are making some short notes. In fact, we usually give some time, like 2 weeks. I give you topic 1. Within 2 weeks, you're done. Give you the next topic like that. So that by the end of the day, as we complete our introduction to our portfolio, which is our last computation topic, you'll be done with the short notes, So you read, you try to understand, and then when we come now to the theory, we look at it together. In fact, these we discuss together. As a team, and it is done. It is as easy as that. Okay, now I just want you to have a definition of financial management. Have it in mind, and then we go to topic number 4, which is time value of money. So you have the definition of financial management, and then we go to that. At least you have the definition of the subject. So financial management is the process of planning. It is the process of planning, organizing, financial management is a process of planning, organizing, controlling, and monitoring financial resources, to achieve organization's objective. So we say that it is the process of planning, organizing, controlling and monitoring financial resources to achieve organization's objectives. So at the end of the day, you find that definitions cut across all these. Whatever that we shall be discussing in any of the topic, it is touching to that definition. Mm. Mm. Process. And you know, for the process, if something is a process, some steps are followed. Some steps are followed. So have the topic subheading time value money. Time value money. Time value of money. Just have that topic with you. Time value. Value money. Time value of money class. That is our topic to start with. We shall start with that topic. Shall start with that topic. Shall start with that topic. Time value of money. Topic number 4, and that is where we are going to start. So from the overview of the time value of money, we say that this is a concept. It is a concept. It is a principle. Mm-hmm. So the concept of time value of money. So if you write in, you can write and say that the concept of time value of money, concept of time value of money, state that a shilling today is worth more than a shilling in the future. A shilling today, the concept of time value of money, state that a shilling today is worth more, worth more than a shilling in the future. A shilling in the future due to its potential earning capacity. Due to its potential earning capacity. Due to its potential earning capacity. This is where I say that if somebody due to its potential earning capacity, due to its potential earning capacity. This is where I say that if somebody owes you money, let them pay you that money as soon as possible. As soon as possible. Because the more they stay with that money, the more the money loses what? Value. The more that money loses value. Mtu asiseme akae na pesa yako kwa muda mrefu. Kwa muda mrefu. And that's why when you borrow money, either from the bank, from the circle, they usually factor in that concept of time value of money. Yeah, within this period of time, this money will have reduced its value, and therefore, the interest that you are going to pay, it cater for what? It cater for that reduction of value. That reduction of value. The value of a shilling today is worth more than the value of the same shilling tomorrow. same shilling tomorrow. Time value of money. You know what? Examiner will bring you a question, 4 marks. Differentiate between time value of money and the time preference for money. Time value of money and time preference for money. So the first one, time value of money. The value of a shilling today is worth more than the value of the same shilling tomorrow. Now, on the other hand, we have time preference for money, which we shall be looking at. When we say time preference for money, that means that an individual needs that money because they have several things they want to do with that money. Why do you prefer that money today rather than tomorrow? Maybe there are some emergency that you want to secure. So we shall look at the time preference for money as well. Time preference for money as well. But in the first glance, kindly note the definition of the concept of the time value of money. The value of a shilling today is worth more than the value of the same shilling tomorrow. So today represent the past, right? Today represent the past. And tomorrow represent the future. Tomorrow represent the future. All right. We have some components of the time value of money, and one of the components is the present value, and this one is given or it's obtained through several techniques. We have 2 techniques. The first one is discounting technique, and the second one is compounding technique. Discounting will deal with the present. Compounding will deal with the future. So if somebody tells me I have these types of cash flow, get the present value of this type of cash flow, I'll be able to do that using the discounting technique. So I would like us to, first of all, differentiate between the two. Differentiate between the discounting technique and compounding technique. Discounting technique and compounding technique. So for the discounting technique, you can say that discounting technique, it is the process. Of converting future cash flow into present value. It is the process of converting future cash flow into present value. On the other hand, compounding technique, this is discounting technique. Compounding technique is the process converting present value of cash flow into future value. Future cash flow into present value into future. So those are some of the definition that we have under discounting technique, and compounding technique. So what is present value? Let's define these terms. Present value, future value, like that. Let's define present value. You say that it is represented with a PV, present value, abbreviated as a PV, present value, like that. So present value class, you say that the current value of a sum of money, the current value of a sum of money, the current value of a sum of money to be received or paid. Current value of a sum of money to be received or paid. Be received or paid. Be received or paid in the future. In the future, discounted at a particular interest rate. 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 Interest rate. Discounted at a particular interest rate. So when you talk about present value is the current value of a sum of money to be received or paid in a future, discounted at a particular interest rate. So to get the present value, we usually discount. It's good to note that. If I want to get the present value, I discount. If I want to get the future value, I compound. So what about the future value? Let's define future value. Define future value. Future value. Future value. FV. Future value. The value of a sum of money at a future date is the value of a sum of money. The value of a sum of money at a future date. The value of a sum of money at a future date, comma, compounded at a particular interest rate. At a future date. Compounded at a particular interest rate. At a particular interest rate. So in the two, the future value and the present value, we have mentioned interest. So the interest rate presented with R, it is the rate at which money grows. Money grows over time. Over time. Sometimes we call it the discounted a discounted rate. Discount rate, the discount rate. Interest rate, discount rate. The rate at which money grow over time. The rate at which money grow over time. The discount rate. The discount rate. And then we have number of period. That time that we're talking about. Number of period, N, represented with a small n. Number of period. Number of period. The number of time period over which the money is invested. The number of period over which the money is invested. The number of period over which the money is invested or borrowed. Or borrowed. The number of period for which the money is invested or borrowed, or borrowed, or borrowed. That is our N. N. Now, I want us to start with the first technique. And our first technique class was discounting technique. Discounting technique. The process of converting the future value into present. Future value of cash flow into present value, into present value. Now, if this is the process of converting the future value of cash flow into present value, we use a factor that helps us to convert. And we said we have two types of cash flow. So the types of cash flow that we have, one is, you can have them, type of cash flow, one, regular cash flow. And number two, irregular cash flow, irregular. So, regular cash flow are uniform cash flow, uniform, maybe synonym, uniform. These are not uniform, non-uniform cash flow. So for the uniform cash flow, there is a way you discount that. Uniform cash flow. So for instance, if I want to discount regular cash flow, to get the present value. When I talk of discounting, is to get the present value. Please note that, discount. Examiner tells you to discount. Examiner wants you to get the present value. Compound. Examiner wants you to get the future value. Please note that. So discount is getting the present value. So the present value will be given by future value times, this is for regular, times PVFA. PVFA, R% and years. Very important. Tumeanza. If I want to get the present value of a certain cash flow, I take the future value given times the PV for R% and years. R%, R for rate, and for the number of periods. Right? Now, what is the PV for formula? PV for formula class will be, can give us now this, can give us this. 1 minus 1 plus R, this is very important, negative 1 divided by R. Now that is the PVFA. That is the PVFA, very important. Tafadhali answer sasa kuweka hizi. And then I would suggest all of you to have a highlighter. Tafadhali, have a highlighter. But for me, because I don't have the highlighter to identify that formula for the PV I just use that. Oh, not visible, not visible, not visible, not visible, not visible. Okay, 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 not visible. All right. It is a present value. You can put it in full is equal to future value times PV R% in years. R% in years. R is the rate, N is the number of years. Aya, sasa nikitaka kuiweka yote hapa, present value is equal to future value times 1 minus 1 plus R, and remember to put that bracket, minus 1 or raised to -1 divided by R. Na nikifanya hivyo, this will give me the present value. That will give me the present value. This is for the regular cash flow which are similar, right? For the regular cash flow. Where PV is the present value. FV is the future value. FV is the future value. R is the rate, interest rate. N is the number of years. Plus is the number of years, number of period. As I would like to know whether everyone have understood this. Important. Are we together? Are we together as far as that is concerned? Important. Sasa kwanza tushike hiyo kwanza. Are we together? Thank you so much, Omondi. Asante. Understood. That is very good. Please make sure that you remember this negative. When we're talking of discounting, it is raised to -n. Raised to -n. Tafadhali. Raised to -n. Tafadhali. Tafadhali. Now, the PVFA, you'll be given PVFA table. We'll be given PVFA table and also PVF table. Kwa paper yako at the end, at the back of your question paper, utapewa PVFA table where you can read them direct, but still you can input them in your calculator. Utasema 1 minus 1 plus R, or the rate will be given raised to -n, and then whatever that you get divided by R. So very important. That is for the regular. Tafadhali. Highlighter, your favorite color, you need to have one. Highlighter inauzwa pesa ngapi? Is it 30 bob? Highlighter inatoka pesa ngapi? Na hii uchumi yetu. Sasa hii ni ngapi? 30 bob or 50 bob? Kuna time ilikuwa inatoka 30 bob. We were selling at 30. Nowadays, I think 50. 50 bob. 50 bob. 50 bob. So you can get a highlighter and make sure that at least your work look neat. Your work look neat. So let's have an illustration. Or before we get an illustration, let's see what about irregular cash flow. How do we get the present value of regular cash flow? The formula of getting the present value of regular cash flow. To determine, number 2, cash flow. To determine the present value of irregular cash flow, here's the formula. Present value of irregular cash flow will be given by the future value times 1 plus R raised to -n. Enough is enough. Enough is enough. Hii haina maneno mingi. Hii haina maneno mingi. Hii haina maneno mingi. Kitu nataka kujua hii ndio gani? In fact, this is I could have written P present value is equal to future value times PVF. PVF. Naona hii PVF R% n years. Ni kama hii. Naona kama hiyo. So this PVF hapa PVF R% n years is equal to 1 plus R raised to negative n. So that's when you come here and say where the present value PV is the present value, FV is the future value, R is the rate of return or the discount rate, N is the number of people, and you are done. Done. Illustration 1. Illustration 1. Illustration 1. Determine the present value, the following cash flow. Following cash flow. You can have here cash flow. So year 1, 2, 3, and 4. And the cash flow for year 1 is 2,000, 2,000, 2,000, 2,000. Use 10% as the interest rate. Use 10% as the interest rate. Sasa nataka tu, I want somebody to tell me which type of cash flow do we have there? Which type of cash flow are this? Which type of cash flow are this? Kindly, someone. Which type of cash flow do we have? Which type of cash flow do we have? That is very good. I can see year 1, 2,000, year 2, 2,000. So they are not dancing. Our cash flow are not dancing. Therefore, these cash flow are regular cash flow. Therefore, if they are regular cash flow, this information is relevant for me. Kindly note. If I have regular cash flow here, I just need one cash flow hapa. Nikuje niweke hapa kama my future, and then I apply my PV for here, and I'll be done. So I don't need to keep on repeating every cash flow and they are similar. No. If I want to get the present value in that case, what I do is just to come here and say to obtain the present value will be 2,000. That is the future. Na ni moja inafanana yote times the PV4. PV4 is 1 minus 1.1 raised to negative. How many years? Raised to negative. How many years? Hapo sasa ndio tuko sasa. How many years? Number of period? 4. So kitu tunaandika pale ni 4 years. 1, 2, 3, 4. So instead of kushinda ukirudia ati 2000, unaweka tu 4 hapo. Kwa sawa, then divide by 0.1. Kuna mtu hajajua nimepata aje 0.1? Where have we gotten 0.1 from? Where have we gotten 0.1 from? Somebody 0.1. Kuna mtu anashangaa sasa 1.1 pia tumetoa wapi? 0.1 is our 10% rate, right? As a decimal. So somebody to give us the present value of our cash flow there. Itakuwa ngapi? It's 2,000 times. You can input this in your calculator. I'll later, in fact, I gave you the past paper. I shared the past paper in the FR group. Kindly, you can use the table. You can open one of the financial management paper and look at the table, the PVFA table. You read for me this. that PVFA. You just go to where you have the rate 10% and then number of years. So for your table, I wish that somebody is doing this somebody is opening a financial management paper whereby tutapatana na rates ziko in low form, rates 1%, 2%, 3% like that, and then tuko na number of years. So number of years. So now 1, 2, 3, 4, 5. Now, if I want to read the rate, I just come here. This is 10%. I read 10%. How many years? 4 years. 4 years. 10% hapa. Where they intersect with the 4, that is the value I need to read. Hiyo ndio value nasoma. Unaona? Tumia table, hiyo ndio value tunasoma. Unakuja unasoma this value here. 10%, that is the rate. 4 years. Where they intersect. That is the value. But if you're using a calculator, just input that and give me the value to 4 decimal places. Always 4 decimal places. I am waiting for that. Waiting for that. 4 decimal places. For those who are using a calculator. And if somebody is using a table, let me know what you're getting. We mili ndungu. Hapana, sio 1 plus R. Oh, 1 plus R. How we got the 1.1, yeah? Hey. It is 1. It is 1 plus 0.1. So itatupatia 1.1. Yes, that is how we got 1.1. Sawa. 3.9020 and it anatupatia 3.9020. And always remember to round off to 4 decimal places. Always remember. Now I'm waiting for 2 more individuals to confirm. In fact, all classes we shall be going with number 3. Once we have 3 students confirming, we just move on. 3 students. So I'm waiting for 2 more students to confirm what they're getting at the PVFA. 10% 4 years. Somebody who is using the table, to confirm. Annette, what did you use? You use the calculator or the table. For the calculator, we need to a direct. 3.1698. I'm now seeing there are some differences here and there. Do not that big, but we need to get the actual thing. So somebody, why can't you use the link to the past paper? 1699. 1699. 6340. Just use a calculator. Kama unatumia calculator, I know most of you are using a calculator tafadhali. If you're using a calculator, just feed this the way that it is. Feed it. For the table, I'll share with you the table. Just feed it. Just type 1. 4 decimal places. Make sure that you're working with 4 decimal places. 1 minus into bracket. Lazima uweke bracket. 1.1 raised to negative n. Negative si unajua mahali iko. Raised to power. Uweke negative number. N yetu ni 4. Right? Then ukitaka unaweza sema equals. Then the answer that you get divide by 0.1. Nipatie, unapata 3.1. Naona watu wanapata 3 point. Sasa nipatie ni 3.1. 4 decimal places. 4 decimal places. Aya. We need to get the present value over base. 1699. That is very good. Amongst you, who is using a table? Nani atumia table? 3.1699. Nani atumia table? Nani manage kutumia table? Aya, nipatie present value. Ni ngapi? Maybe to 1 decimal place. 6339.8. 6339.8. That is the present value. That is the present value for that. That is the present value for that. That is the present value for that. All right. All right. All right. All right. 39.7.8. Okay, that's good. Then we have another illustration here. Another illustration here. Determine the total present value of a project with the following cash flow. The interest rate of the project, the interest rate or the rate of return is 12%. So the project year 1, 2, 3, 4, and 5, and the cash flow is 7,000, 8,000, 2,000, 5,000, and 1,000. 1,000. Which the first thing to determine is the type of cash flow that you're dealing with. Which type of cash flows are these, class? Which type of cash flows are these? Irregular. Thank you so much. And therefore, which factor are we going to use to discount? Which factors are we going to use to discount? Are we going to use PVIF or PVFA? PVIF or PVFA? PVIF or PVFA? Are we going to use PVIF or PVFA? PVIF or PVFA? Buka tuko na mbili. It is PVIF. So we discount using PVIF 10 and not 10 but 12%. So for this class, you usually look at every year. So we find PVIF for every year. And the PVIFs are 0 point. Unaona sasa PVIF imekuwa not 0 point. It is a whole number. Point something. For the PVIF, whole number in most cases. But PVIF, I expect 0 point. So give me the PVIF to 4 decimal places for year 1. So itakuwa rahisi sana. 1.1 plus R raised to negative n. Hii ndio formula unatumia hapa ili kupata hiyo. So nipatie ya kwanza, rahisi zaidi kama kumeza mate. Rahisi zaidi kama kumeza mate. Nipatie ya kwanza to 4 decimal places. Like for example, the first one is 1.12 raised to negative 1. Hiyo inakuwa umemalizana nayo. Ya pili, ya tatu, ya nne, ya tano. So nipatie ya kwanza. To 4 decimal places. Watu wa calculator. The first one is 1.12. Sababu rate ni 12%. Raised to negative what? 1. Mwaka ya kwanza ni raised to negative 1. Mwaka ya pili raised to negative 2. Like that. Nafuatanisha hivyo. Fuatanisha. But these remain constant. I change. Haya, ya kwanza 0.8929. Ya pili. Twende ya pili tafadhali. It will be 0 point something as well. Let's move. It's something that once you practice as many times as possible, it will become very simple. Very simple. Ya pili. Ya pili, as we wind up. You're almost winding up. 79, 72. Ya tatu 0 point. Inaenda ikipungua. Hiyo hata unajimakia ukisonga. Hiyo unajimakia ukisonga. Ya tatu 7118. Ya nne. Almost winding it up. We're getting it here. Winding up. 6355. 6355. And the last one. But ya mwisho sasa. Ya mwisho. 1.12 raised to -5. -5. Takuwa ngapi? 5674. You see, there's a difference between for the irregular and that of regular. Regular ni direct, hiyo haina maneno. Hii nayo lazima uangalie each. So the discounted cash flow or the present value, you just take these times this, like that. We get all of them, then we add. The total present value will be the summation over all of them. So give me the first one. The first one, it is 7,000 times this. Ya kwanza. Maybe to 1 decimal place. The first one ngapi? Now this is a matter of multiplication. 7,000 times 0.8929. 1 decimal place, sawa. Let's wide it up. Aya, ya kwanza tunapata ngapi? For the interest of time, 6250.3. Ya pili, very fast. Speed sasa, tuanze kuongeza speed pole pole until we get to that point where we don't even look at the calculator. 6377.6. Want to get to that point, we don't even look at the calculator, just punch your calculator without looking at the buttons. So next one, Annette, Mary, on Monday, 1423.6. Sheila. We're doing well. Give me the final two. The second last. And the final one. 3177.5. And the last one. Give me the last one. Asante. Nipatie ya mwisho tukisonga. 5674. 5674.0. Give me the total. They wanted the total present value. Na chapa yote. Unaongeza yote. Total. Ni ngapi pale? And we say that we need to have two books, one for the classwork, the other one for assignments. Like for instance, now we have this assignment. Number one. 17,796. Determine the present value of project D with the following. The following cash flows. Year 1, 2, 3, 4. Cash flow here you have 700, 200, 500, 700. Rate of return. Number 2, what is the present value of cash? Use 13% as the rate. So use 13% as the interest rate. So you do that too, and then you share. As we say that once you do any assignment, you are required to share. You are required to share in the group. You just take a picture and share in the group. Share in the group. Share in the group. So you can do that too. Questions and share in the group. Are you done? Want us to prepare for work now? Are you done? Once you're done, let me know. Once you're done, let me know. Once you're done copying the questions, let me know. We have 2 questions, 1 and 2. Done. Thank you so much, Omondi, for that. Asante. That speed is now growing. The speed is growing. Speed is growing. Speed is growing. That is very good. Mary Dan, thank you so much. Thank you so much. 2 more. 2 more so that we can widen the session. Sheila is also done. Asante. Asante, Sheila. Maureen, you done? And I request for the video. I've just joined late, kindly. All right, no problem. No problem. The video will be available. I hope you are uko kwa RMS. I will be posting, the video will be posted in our RMS. And kindly, leo tena nimeshare the link to the for our class. Kindly contact this number. Let them enroll you. Let them register you in the RMS. 790, 70, 30. This is 30. 79, 30. Kindly get in touch. Kuna time itafika ukute kwamba we are not sharing that link in the group. I decided to share because I had seen that no one had joined through the RMS. Yeah? So let this guy enroll you to RMS. Tafadhali. Get in touch and make sure that you're able to access the video in that platform. The learning management system, you are able to access the video and the link to the class. Link are always there. So I think that is done. That is done for today. I hope you've learned something. Let's plan for next week. And next week we shall be choosing our class representative amongst us. Otherwise, that is it. How do you access RMS after registering? How do you access? You log in. You have your details. You need to have your details, the email and password. You'll be getting in. Lazima una log in. Ukitaka kuingia, una log in. You have your email and password. So you log in. You find, go to CPA. Naenda kwa financial management, ama kwa financial reporting, ama any other unit. You find the videos there. Some notes and also the link to the class. and how to access video ziko pale, ziko tu hapo kwa LMS, hapo. First of all, get and load, and then you'll be able to do what? You'll be able to get access to all the materials. Sawa, Maureen. Yeah, get in touch to 790 30 79 30. They'll be in a position to guide you through. I think that is it for today. Allow us to edit at that point. Let's purpose to do this and share. Then we shall meet next week. Otherwise, thank you so much for having time to attend our today's session. Pressure hosting you. Asanteni sana. May you all have a blessed day. Goodbye. Asante. All right. So